Study today is on a 37-year-old real estate investor. You'll see that he's going to take a $50,000 policy loan in the 4th year of his policy. He'll make money in the real estate deal with positive cash flow, and he'll keep making money on his total cash value in the policy. This is a properly structured high cash value policy. He's putting $20,000 a year into the policy, and we're focused on maximum cash value growth. So you notice here in this column, the net cash value year 1 is $18,778. The majority of his premium is going into cash. And every year thereafter, you see that cash value continuing to grow. There's a guaranteed rate of return, and there's also a return called a non-guaranteed return that includes an annual dividend. The companies that we use, they've all paid dividends over 100 years, so you can plan on getting a dividend, and then that's reinvested back into the policy's cash value. Let's say here in year 4, he wants to take a $50,000 loan and he has $80,000 of cash value. He's taking the policy loan for the down payment portion on the real estate deal. He'll still get bank financing for the difference. What I recommend is taking policy loans for the down payments on your real estate purchases. What he's able to do is call the insurance company, ask for a policy loan. They'll do a direct deposit for the $50,000 in his bank account within 3 to 7 business days. There's no credit check, there's no application, and the insurance company doesn't question him what he needs the money for. The loan is easy to get, and the insurance company gives him a loan from their general account. They're going to put a lien against his $80,000, but they don't physically remove the $50,000 from his $80,000 cash value. Let's look at the details of the policy loan so you can see he's still making money on his total cash value and the net result of that. His $80,000 cash value that's in the policy isn't going to be touched. He's still going to make money on the $80,000. When he requests the $50,000 loan from the insurance company, they put a lien against the cash value. He's still earning interest and dividends on the total of the $80,000. He's compounding money on the total of the $80,000 even though he has a $50,000 loan. Let's look at the numbers. He's going to pay 5% interest for the loan. That interest does go back to the insurance company. But what we want to recognize, let's assume that this straight line represents the dollar amount of 0. When he takes the loan for the $50,000, he's going to pay that back over time. So there's principal reduction. He pays a monthly payment back, which means every month the balance of that $50,000 loan is going down. Here's what that looks like. We put in our 5% loan rate, and we'll run this over the course of 5 years, which is 60 months. Now, because this is your own bank and we're using the infinite banking concept, you get to choose how you want to pay the loans back. If you want to pay this loan back over 5 years, over 10 years, over 20 years, that's up to you. I have some real estate investor clients, they don't want to pay loans back until they're done maybe rehabbing a property. So let's say they want to buy a fix and flip. It's going to take them time to get that work done, to put the property on the market, to actually sell it and then close escrow, and then they can take their profits and pay off the loan in one balloon payment. The insurance company doesn't force you to pay the loan back. We're going to recommend that you're an honest banker and you do pay the loans back. And in this case, we're showing those loans paid back every month over a 5-year time frame. The payment would be $943 a month. A portion of that is going to principal and a portion of that is going to interest. And what we see is the loan balance going down. So every month you see the interest is going down because the balance of the loan is going down. Over the course of those 5 years, he would have paid a total of $6,614 of interest. That interest went back to the insurance company. We're going to make note of that. $6,614 $614 of interest. Again, goes back to the insurance company. But remember, the $50,000 didn't leave his policy. He was still earning interest and dividends on his total cash value, even though he has a loan for $50,000. We're going to look at a future value calculator. We're going to put in the $50,000. This policy has an internal rate of return of about 4.8%. And over that same 5-year time frame, or 60 months, that $50,000 would have grown to $63,532. Now you're going to notice he paid 5% interest, but his policy is earning 4.8%. In some of my clients' policies, they might earn 5.2% interest, others might earn 4% interest. You're going to see here that either way, he still comes out ahead, and that's because of the compounding. In this example, the difference between $50,000 and $63,000 is $13,532. So let's make note of that. And you'll recall he paid $6,614 in interest. When we look at the difference between what he earned in the policy over that same 5-year time frame and what he paid in interest, he still came out ahead, a positive $6,900. He's still making money in the policy. He's still earning compound interest, still earning dividends, and he's making money in the real estate deal. This allows him what we call the velocity of money. He's making money in 2 places. The policy loan feature is powerful. With high cash value whole life insurance and the infinite banking concept, you're growing money guaranteed. You have access to the liquid cash. You can protect your money from creditors and bankruptcy in most states, and you can invest in an asset that never stops growing. High cash value whole life is that asset. You also have a future opportunity for tax-free retirement income, and you can leave a guaranteed legacy to your heirs. The benefits go on and on. We can put your illustration numbers together, and you can see for yourself how powerful a high cash value policy can work for you, and utilizing the infinite banking concept can grow your money and your wealth more rapidly throughout your life. Steve, back to you.
Thanks, Barry. Great real estate investor example. Really good look at the numbers as to how this policy provided with a $20,000 premium, how there was roughly $18,000 available in year 1 for real estate investment purposes, policy loan. In year 4, Barry's client did a $50,000 policy loan, and in his example, as you saw, he gave the method of repaying that loan that this particular client took. And this is a powerful aspect because as you pay back $1 of a policy loan, that money becomes available again. So it's interesting to see Barry lay that out and how that policy loan repayment unfolded. And remember, there is total flexibility when it comes to paying back policy loans. So this is just one example of how these loans can be paid off and how that money gets replaced within the policy when repaid. So Barry also explained that the cash value kept working within the policy, and he ran some quick numbers to say that even if there was a 4.8% return in the policy and a 5.2% loan rate, that the compounding effect of the cash in the account the entire time still allowed that policy to outperform the costs. And that's called the velocity of money. You got money working in 2 places within the policy and also actively within the real estate investment, thereby increasing your ROI. So in adopting this strategy, Barry's investor client was able to obtain guaranteed tax-free growth, asset protection with dividends and living benefits to boot. So great stuff. If you're a real estate investor, this applies to you. Wherever you're watching, there's going to be a calendar link below where you're watching. You can schedule a one-on-one with Barry and look at your own numbers. Consider how this will apply to you in your real estate investing. I also encourage you, if you have questions, you want to leave a comment, please do so in the comments section. We respond to every comment as long as you keep it classy. And with that, appreciate you watching today, and we'll see you in the next one.